Morning, good afternoon, good evening, wherever you are in the world. I'm Nicolas Véron. It's my pleasure to introduce this session of the Financial Statement Series at the Peterson Institute for International Economics. And today we'll discuss Germany's institutional protection schemes. It sounds like a very arcane, very country-specific feature, and in a way it is, but it also has resonance at the European level for European policy. So we'll focus on this read across from Germany to Europe and try to understand what's at stake here. I'm very grateful to my two fellow panelists today. Tobias Tröger studied at Ludwig Maximilian University in Munich, where he got his doctoral degree in law in 1999 and then went to Harvard Law School with an LLM degree in 2004. He also got the habilitation, the German professorship degree at University of Tübingen in 2011. Actually, he has spent a decade at Tübingen's Eberhard Karl University as a lecturer between 2000 and 2010, and did 18 months at University of Passau as a visiting professor of law. And since October 2011, he's been at Goethe University Frankfurt, which is, of course, the leading institution for everything that has to do with finance and law in Germany. Not only is he a chair in various aspects of law there, but he also was instrumental in the creation of the what is now the Leibniz Institute for Financial Research, known as SAFE, Sustainable Architecture for Finance in Europe, where he has been the director of the cluster on law and finance since April 2020. He's also managing director of the European Banking Institute, which is a research network on banking issues in Europe. And I should mention also his role as an advisor to the European Parliament. Actually, one of the triggers for this session is a paper that Tobias has co-authored with his colleagues Rainer Haselmann, Jan-Peter Kranen, and Mark Warenburg for the European Parliament earlier this year, precisely on this issue of Germany's institution protection schemes. The second panelist is Michael Wolgast. He studied first in Paris at University Dauphine, then at the London School of Economics and Political Science, where he got a Master's of Economics in 1987, then a doctorate at Kiel University in Economics in 1995. He started his career at the Ministry of Economic Affairs at the time in Bonn, and then went into the financial industry at Deutsche Bank, and for a number of years between 2001 and 2014 at GDV, which is the main association of German insurers, where he was the chief economist. Then, relevant for our session, also chief economist at the Deutsche Sparkassen- und Giroverband, DSGV, which is the main association of the savings bank group in Germany between 2014 and 2017. And then he was the main representative in Germany of Moody's, also a supporter of the Peterson Institute between 2018 and 2020. And since October 2020, he has been a partner at the consultancy firm, which also does policy research, Berlin Global Advisors. Michael has been very active in the policy space. He's also been a research fellow at ASMT, the business school in Berlin, in 2017-18, and he's been in 2017 as well, an advisor to Christian Lindner at the time in the coalition talks, where the FDP, Mr. Lindner's party, did not join the coalition, but Mr. Lindner, of course, is now finance minister of Germany. So all that is very relevant for our topics. With that, Tobias, over to you.
Yeah, thanks, Nicolas. Thanks for having me. Let me just share my slides. Thanks for really making the session possible, which is on a topic that, as you rightly said, seems to be somewhat arcane, but on the other hand is extremely relevant because it involves some powerful players in the German space, but also in the European discussion. And let me just tell you a little bit about the background. So the European Commission has started a consultation in the spring of this year on the review of the crisis management and deposit insurance framework. And there was a pretty prominent joint statement from institutional protection schemes from 6 member states that demanded a preferential treatment in this whole endeavor. And they claim that they have special intervention tools and resolution instruments which sets them apart from the rest of the banking sector because they're more effective, and therefore they can guarantee the survival of the member institutions that are part of the institutional protection schemes, and therefore there is no need for them to be part of any deposit insurance or deposit guarantee scheme on a European level. And the main claim, of course, is that they've been so successful in the past, so that none of their customers have ever incurred any losses, and therefore they can rightly say, at least that's the claim of the statement, that they should be set apart in regulatory treatment. And if you look at the whole discussion in Europe, of course, deposit guarantee schemes are really the hot potato that no one really wants to touch upon. And if you now have some important player that wants to get out of the game, that's certainly something that is relevant for the completion of what we call the banking union, so the integration of the regulatory and supervisory framework for the banking sector. And as Nicolas already said, we prepared an analysis for the European Parliament that looks into the design and the operation of institutional protection schemes, and also tries to figure out what are the strengths and what are the weaknesses. So essentially, what is the what's the factual ground for the normative statement of our institutional protection schemes here, and make some recommendations for the regulatory treatment, which look pretty different from what the institutional protection schemes actually asked for. And I want to just focus on the main takeaways of this study for today, just to give you an idea of the economic relevance and the significance of the issue. This is something, some figures on the market share of institutional protection schemes. So what is important in the graphs above are the red and the green lines, which show you that both for deposit taking and also lending to non-banks, so meaning largely customers, these institutions that are a member of the institutional protection schemes in Germany have a very, very high market share. In lending, it amounts to more than 57%. And with regard to deposit taking, they're sucking up all the market power, more or less, like almost 82% of the deposits from non-banks, so from retail customers and others, go to member banks of the institutional protection scheme. So these are really economically
Yes, sorry to interrupt you, but just to set the scene, so there are two institutional protection schemes in Germany, right? One is for the savings banks, the other for the cooperatives. Can you just, tell us a little bit more, just to introduce those features without going into all the gory details, of course.
So that's actually what we do here on the next slide. Okay. So as you rightly said, there are two, but they share the common features that they are predetermined through regulation by now, but also historically, they essentially have two critical features. One is the members of the institutional protection schemes are monitored through a central institution, which is an instrument for crisis prevention. And on the other hand, if something goes wrong, there is a promise of adequate support for a non-viable member, so a crisis management framework that also allows them to rescue the institution. And thus the name institutional protection scheme, because it's not that they protect customers, but they really protect the individual institution. And as you rightly said, in Germany, we have two of those. So one comes from the savings and loan sector, and the other one is from the cooperatives. But these features are pretty much similar. And what is also important, beyond this crisis management and prevention mechanisms, you also have some interlinkages between the member institutions, because there are cross shareholdings, and there also is a joint liquidity management, which means that there are intra-group loans between these. And quite importantly, despite these interlockings, for supervisory and resolution purposes, all the members are treated on a standalone basis. So there is no consolidation on a group level. And that has, of course, important implications with regards to capital adequacy regulation. It has also important traction with regard to the capital endowment for bail-in purposes, so for crisis management. And of course, also for the oversight, because if you only look at the individual institutions, they typically don't reach the size that they come under European supervision by either the European Central Bank or the Single Resolution Board. But on the other hand, you have some privileges regarding, for example, the deductions of own funds, risk weights, etc., that are entirely the same as you have them for a consolidated banking group. So you have the best of both worlds for these institutions. Now, what about the statement, we're just better? Is that true? And here it becomes interesting because, as I said, there is this mutual burden sharing arrangement, but the evidence that suggests that both the monitoring and the support across the different levels in the IPSs, so not only the individual member banks, but also the apex institution above these individual banks which operate locally. So in the German context of the savings and loan sector, particularly the Landesbanken, these crisis monitoring and crisis prevention mechanisms don't seem to work, because what we have here are some numbers, and you only have to briefly glance at the government support that has been handed out to the sector here. And the critical number is really this, because as you can see, it's more than double the amount in billions of euros that has been handed out to the private banks during the cleanup after the financial crisis. So this is a clear indication, in our view, that the crisis prevention and management framework that is set up in the institutional protection schemes doesn't really prevent the government from stepping in as a bailout institution. And therefore, we think that the track record has to be qualified. It's not only about customers, but it's really the question, does it work in the whole institutional protection scheme or not? And therefore, just to finish, we think that the institutional protection schemes are, after all, not that different from a consolidated banking group, because if you think about what they do, this protection scheme-wide risk monitoring leads, of course, to significant coordination of business activities, which is a common feature in a consolidated banking group. On the other hand, the monitoring exercise that is done in the institutional protection scheme is something that similarly the consolidated banking group can do. And most importantly, the credibility of the unlimited support promise that is inherent in the institutional protection scheme, of course, hinges on the network-wide loss absorption capacity. So only as much money as you have can you really commit to rescuing some of the member institutions. And that's exactly the same situation that you have in the consolidated banking group. And now, given that these banks typically operate locally and they have a relatively limited amount of financial products that they offer to the customers, that also means that their potential for diversification, for risk mitigation, is rather limited. So they are actually the ones that are pretty prone for systemic crises. And therefore, it's quite interesting that the regulatory framework so far treats them so different from a consolidated banking group. And what we offer, and what we certainly will discuss controversially today, is that our analysis more or less leads to the conclusion that we should really rethink the standalone treatment in both regulation, supervision, and also, of course, resolution as part of that. And particularly with regards to the missing part of the banking union, deposit insurance, we think that institutional protection schemes should not stand apart, but instead they should really be integrated part of a national and then European deposit insurance scheme. And let me just stop here, not to over-exploit my 10 minutes, and then see what Michael and all the others have to say. Thank you very much.
Thanks very much, Tobias. Michael.
Yeah, well, thank you for having me. A pleasure to be here with this fine group. And let me start with some remarks as an economist and then comment on the political questions that were also part of the invitation, and apologies for being very short and maybe bold on some of these aspects. First of all, on EDIS. yes, EDIS is deposit insurance is a meaningful concept in terms of financial stability, and a pan-European system would be better than the current fragmentation. But then deposit insurance, like any insurance, also implies a degree of risk management and risk adequate premiums. So there's a lot to work on before we can implement a true European deposit insurance schemes. NPLs, the state bank nexus are just two examples. So my first statement is that the feasibility of EDIS is more complicated, and it's not only, if at all, depending on consistency with the IPS systems in Germany that we have at present. Then on IPS, and here I can only agree with Tobias, and let me introduce the thought experience to all of you. Could we have a pan-European IPS comprising the whole European banking sector? Now, as an economist, you would say that is utter nonsense. You cannot have that, and it's not a meaningful concept either. So that, I think, is a clear indicator that an IPS has not so much to do with financial stability, and it has more to do with the banks that assemble within the respective IPS. And the additional contribution in terms of financial stability is marginal, if present at all. Then Tobias has hinted to the experience that we have had. Very often, if there are issues with the members of an IPS, they have to resolve it in a different way rather than resorting to the IPS. Bank mergers between local banks, state aid in the case of Landesbanks. So what the IPS are has more to do with the history and the identity of the two groups in question, and that's not a financial stability concept. Now, the question of the day that Nicolas has put to us, is that a reason that we see so little progress on banking union at the European scale? And let me first say that, of course, progress on banking union is not identical to progress on EDIS. There are many more issues, and there are many more opponents to progress on banking union than just to EDIS or just being Germany. So I'd say that the current conception is more due to that many had hoped Germany would be sort of a white knight in terms of banking union. The new German government would take the lead and overcome all the obstacles, and that the German government has not done, of course. And if you look at the party manifestos and the coalition treaty, that's not a surprise, because there are many sort of caveats to banking union and to EDIS that are being spelled out. Now, is that a lobby success of the two groups that are behind the two big IPS systems in Germany? I would say no. It's more mirroring the general attitude that you have in Germany on these issues. And one issue is that, one observation is that the Germans are sort of ultra-conservative when it comes to financial matters, and they prefer to stay with their Sparkasse or cooperative banks. They have almost unlimited faith to these institutions. And so both systems can rely on huge support from the general population, which in turn spills over to what the government has to do, because clearly it's a democracy and you have to look at the majorities. Also, there's a broader mood in Germany that all the systems that we have had in Europe over recent crises, and especially this redistribution, comes at the expense of the German taxpayer. And unfortunately, EDIS is put into that context. So many Germans fear that they lose money if European deposit insurance is being introduced. And then a last observation before I conclude. Also, deposit insurance is not a traditional concept in Germany. The Germans like to trust their bank and not to look at the details. And for decades, we have not had deposit insurance at all. So it's a new concept. I'm old enough to remember the times when we haven't had it, and also what has occurred then. So in some, the climate in Germany, the political climate, is not particularly friendly to a concept such as EDIS. And that has not so much to do with the two IPS and the respective groups. Two statements in order to conclude, and also for the sake of discussion, if I may. First, would EDIS really be at odds with the existence of the two large IPS in Germany? I doubt it, and I think Tobias also referred to that in his statement to the European Parliament. I think they can easily coexist, EDIS and IPS. So from that cannot be the reason why we do not have EDIS if IPS can easily be consistent with EDIS. Then, more broadly, can you blame the two German IPS or the groups behind them for the current lack of progress on banking union? I would say no, it's far too easy. Of course, both groups are often eager to preserve the current status quo, very conservative, like their clientele, like the Germans themselves. But the narrative that only Germany has failed to bring about progress in Brussels in June, and behind that is the two large IPS, I think that's far too easy, and I think we should look at it in more detail. Thank you.
Thank you very much, and also thanks, special thanks from me as a moderator for your admirable time discipline. Let me take it from there, we have already a few questions, so why don't we start with a question from Jörg Genner. And I'd like to have both your answers to this. How do you see the differences for what both of you have been talking about so far between the two IPSs? There is what you referred to, Tobias, as the savings and loans, or Sparkassen, that's the DSGV, that's the acronym of the kind of national structure. And the other one is the cooperative sector, which is known as Volksbanken, Raiffeisenbanken, and also the national structure, which is called the BVR, BVR in German. So we have those two institutional protection schemes. I apologize for the numerous acronyms, but that's the world we're talking about today. One is savings banks, which are public sector, essentially owned or controlled by municipalities and regions, including the Landesbanks, the regional banks, and the other is the cooperative banks, which are private sector, but not joint stock companies. Sorry again for those introductory pieces. So we have those two, savings bank cooperatives. How does it differ? How do you look at them differentially? Maybe Tobias first and then Michael.
Yeah, so I think the admirable quality of the host is that they always preempt the answers of the speaker. So in a sense, I think you've already set the main difference, because that is really the political, well, how deeply nested the Sparkassen, DGSV is in the political system of Germany. And that, I think, sets it a little bit apart from the cooperatives, from the regulatory treatment, etc. There's no big difference, other than, as you also rightly referred to, the ownership structure. But the ownership structure is pretty important here because, you know, we have a federal system, and that means that also the level of municipalities, communities, counties, etc., you have a deep interlinkage between these institutions and politics, local politics. And then if you go one level further to the states, where you have the apex institutions that I referred to, the Landesbanken. I mean, you don't have them in every state anymore, but still there are some politicians on the state level that are deeply intertwined. And that, of course, gives, as Michael has also hinted, these institutions a very, well, very open channel, in a sense, into politics, to articulate their interest. And also, of course, it's a mutual interest, because what you also have to understand is that particularly the Landesbanken historically have played a role in sort of, you know, getting around budget restrictions, because in a sense, if you could not extend any subsidy, you could easily extend a loan through a Landesbank. So that was also an option that in politics was present. And therefore, there is a historically grown interdependence of the sector with politics and intertwining, and I think that sets it apart a little bit from Volksbanken, Raiffeisenbanken, so the cooperative sector, but that is not that prominent.
Mm-hmm.
Okay.
Yeah, maybe just one or two additional elements, and also because I think we have an international audience who are not so familiar with the details of the German banking sector. One difference is that the system in the cooperative sector is much older than the system with the savings banks. And one reason is that the savings banks have enjoyed full state guarantees until about 20 years ago. So they didn't really need a mutual support because they had these guarantees from the public sector. And then one other observation, and I'm sorry to be so bold here, and I know there are people from the sector in the audience, but if you look at the statistic that Tobias has just provided, the losses that were incurred despite the existence of an IPS, they were all with the Landesbanken, so part of the Sparkassen sector, not with the cooperative sector. The cooperative sector, I'm not aware that they received state aid. Maybe back in time, I'm not sure, but at least not in the financial crisis.
So, Tobias, do you want to comment on this? And there was an indication in one of your slides. You said for the Sparkassen, the local savings banks, which again are typically municipal establishment. It seems to work, but we're not in the machine room, I think you said in one of your slides. Can you expand on that and tell us exactly what we know about what Michael just referred to?
Yeah, so what I meant by this is that the statement that no retail customer has ever incurred any losses is correct on its face, on its face. And as Michael has also hinted, that has been largely achieved through essentially what you call in bank resolution purchase and assumption. So failing institutions have just been dumped into stronger institutions in the vicinity. And therefore, that is something that has happened. So that is a clear indication that the pre-crisis monitoring did not really work that well, because I mean, if that works, you don't get in a situation where you have to think about the application of quote unquote resolution tools, although it is all within the institutional protection scheme, so we don't know what exactly happened. And in these situations, we don't really know very much on how these crisis management solutions came about. That's why I'm saying we don't know that much about the particularly the crisis prevention mechanisms. We know, of course, the descriptions that you can read on the websites of the institutional protection schemes, and everything looks very fine and dandy there. And it's also, I'm not saying that it's an inefficient mechanism per se, but you know, if you look at some of the indications, it's most of the time that there is, from the supervisor who is outside of the institutional protection scheme, some indication, well, there's something amiss in your network, please take care of that. And this is when they start managing the crisis. But that's only something that you can see from the outside. What's really happening inside, we don't know. And let me just say one important thing, why we see all these government money flowing into the sector at the apex institutions at the Landesbanken. So the mutual support commitment is not unconditional. So it's not that it automatically is triggered if one of the institutions in the protection scheme is in crisis. There still has to be a vote on the level of the regional protection schemes. And they can also say, oh, we don't do it. And that just happened during the financial crisis. So for various reasons, some of the very powerful local savings and loan funds simply said, we're not going to support some of the Landesbanken. And that's when the system breaks down. And then the government has to come to the rescue.
Yeah.
Because this is really important for our audience. What you just said, Tobias, if I understand correctly, applies to the savings bank system, not to the cooperative bank system. So the cooperative bank system has kind of a unitary system with one financial structure for the entire network and for all of Germany. By contrast, the savings bank system has 11 so-called sub-funds, Teilfonds in German, and actually 13, 11 regional funds, which are managed by regional associations of saving banks. And then there are two funds, one for the Landesbanken and one for another small segment called the Landesbausparkassen. So in total, you have 13 funds, and that's where the money is, right? So it's not like there is one pot of money at a consolidated German level, but you have complicated interaction between those 13 funds. Is that correct?
Yeah. So it's and the description is entirely correct, and it is really the interface between the 11 funds for the local savings and loans and that for the Landesbanken and for the, as you said, Landesbausparkassen, which is, the Anglo-Saxon equivalent that comes close to that is building societies. So that is more or less what it's up. And these didn't face any crisis so far in the recent past, at least none that led to any significant problems with individual institutions. And therefore, what we observed in the past is really when you have a crisis in one of the sectors or one of these compartments, if you want to call it like that, and the firepower of the support fund in the compartment does not suffice to manage that crisis, and when you want to cross-subsidize the crisis management in one of the compartments. That was when we observed the breakdown. And that only happened during the financial crisis in a one-directional situation when the Landesbanks were in a crisis and the savings and loan would have to come to the rescue.
Yeah, I would like to come in here because what you said sounds a bit like the IPS has not worked. And I think you may hold that as an opinion as an economist, but technically or legally, it's not true. And that is what the two groups insist on. And I must admit that personally, I'm also not fully convinced when they say, and this is a typical quote in the political realm in Germany, that we have the two tried and tested systems, the bewährte Systeme der Institutssicherung. Is that true, yes or no? And I think it is a philosophical question. Technically, we have not seen one single bank from these systems fail. So in that sense, it's true. But then we have seen many instances where banks or issues with banks have been resolved in a different way, like, as you say, small banks were bought and absorbed by others who were sound enough to digest that, or the Landesbanken received state aid. Now, state aid, in the case of Landesbanken, has not been taxpayers' money per se, because it's money from the owners, because the federal states are the owners of the Landesbank also. So the owners gave money, and with the blessing of the European Commission. So all this is technically okay. And the reason why the IPS did not have to come in was because the owners reacted before the institutions had to make a final call to the IPS. So you see, it's a very philosophical question. I think tried and tested is probably too strong, but you cannot say that the system has failed either.
So, for clarification, when you say the federal states have provided the money, you mean the local and regional governments, right? Not the federal government of Germany.
Yes. All the money that is in the chart from Tobias is from the federal states.
Again, using a US parlance, I would call them the states, but not the federal level, because it's not the government in Berlin, it's a local government in Stuttgart or Munich or Hanover or what have you. That's for clarification. The other point you made is about taxpayers' money. I think we can agree it is taxpayers' money because it comes from those government entities, but depending on the cases, there have been cases where it has qualified as state aid, for example, VestLB, and other cases where it hasn't qualified as state aid. For example, NordLB, which was not in Tobias' chart because it's more recent, I guess, but where there has been an infusion of capital into NordLB by a mix of the Sparkassen savings banks, organizations, and for most of the money by the local governments. But it was considered an arm's length capital raise, rightly or wrongly, we can debate, and therefore not determined as state aid by the European Commission, correct?
Yes. That's true.
Okay. And in a way, that's, I mean, there are so many financial plumbing questions here that I don't know where to start. Tobias.
And let me just add one thing, which I think is important. You can, of course, say, well, legally, that's all fine, and we did not really see anything failing. But, being a lawyer, I would qualify that because one basic corporate law thing is that even if you're an owner, you're not obliged to put in additional money. So it's a choice that you make. And that, of course, indicates that, it's not a natural thing. And then saying, well, of course, these IPSs didn't fail because they were bailed out. That's a little bit, sophistic because what's the alternative, what's the counterfactual, right? So if the markets didn't want to give any money. So I'm just putting that out there, just to make that clear.
And I think this vocabulary of failure and bailout and taxpayers' money, it's very slippery in those cases because indeed there are so many different features. There's a question by Klaus Schalk. Is there legal or contractual support obligation in an IPS? And I think that's a very fundamental and important question. So maybe let's start with this. Tobias and then Michael.
Yeah, just very quickly. So it is hard to find that because that is something that is not so easily accessible through the websites. But the most important aspect here is that there is no unconditional support requirement. And that is, I think, the most important thing here. So there has to be a resolution on the level of the individual funds. So meaning on these funds, the 11 funds and the other funds in the savings and loan sector. And that is essentially something that is driven by expedience. So it's not really that these people would neglect the fact that, of course, it has a strong reputational effect if you don't support your institution. And that is why it works reasonably well with regard to local banks, because there the reputational consequences for the business model of the whole sector is at stake. But the interlinkage between the Landesbanken and the savings and loans on the local level is less strong, and therefore there you can already experience that it is not an unconditional support commitment, and therefore in some instances it may just lead to a resolution where they say no.
Well, no addition from my side. This is factual knowledge, so I can only agree.
So we have a point framed as a question from Michael Véron in the Q&A, which is a bit about this. Michael Véron says, isn't it the case that the state aid or public financial support to the Landesbanks was indirectly support to the local savings banks as well, because there are so many financial connections between the savings banks and the Landesbanks that if the Landesbanks had been allowed to fail, that would probably have had ripple effects in the local savings bank network. Maybe, Michael, can you enlighten us on this?
Yeah, I think this is true. I mean, the regional Sparkassen were owners of the Landesbanks that were in trouble. So for them, it was an ideal solution that the respective state went in and put in additional capital, and that they did not have that on their table. And also because typically there are business relationships between the local Sparkassen and the Landesbank, and the sector as a whole and the Landesbanken, that is very likely. I mean, I don't think there are any numbers or studies on that, but I think that's very likely. But then, I mean, again, putting that in a philosophical context, I mean, any of the rescue packages has side effects for any business partners of the institutions that were rescued. That also applies to HRE, et cetera, right?
So Michael Véron has actually asked for the floor, and I can do that. So Michael, if you want to unmute yourself, you can talk, but briefly, so that we can expand on this.
This is very kind of you, Nicolas. Thank you very much, and hello, this is Michael Véron. Yeah, indeed, I mean, it's well known that the smaller saving banks have always channeled excess liquidity to Landesbanks who have lent them to larger corporates active in Germany and abroad, and ultimately. So there are very significant exposures, and I personally don't think this is a philosophical question. I mean, yes, indeed, it's ultimately, it was within a frame and it was approved by the Commission as stated, but, you know.
Okay, Michael has been cut off, not by me. I should mention that he's an advisor at the European Central Bank, but that's public knowledge. And indeed, I mean, let's unpack, maybe Michael will come back, but in the meantime, let's unpack what happened with NordLB, right? Because I'm still not clear with that. It's one of the more recent examples. As I said, it has not been considered state aid, but it has been an infusion of cash largely from outside of the institutional protection scheme by the local government entities, particularly the state of Lower Saxony, but also others. Does that mean that you mentioned the fact that there is a fund, a national fund of the Landesbanks, which is one of those 13 funds in the architecture of the savings banks institutional protection scheme. Does that mean that the Landesbank fund was depleted? Or does that mean that it has just decided not to provide all the capital that was needed and therefore has a negotiation with the local government that the local government should put money of their own? Can you give us a sense of how that works? Maybe Michael and then Tobias.
Oh, I mean, this is a very long story and a very complicated story. Trying to put it in a nutshell. Again, we had the situation that we have referred to all earlier in this conference, that the IPS sort of waited whether other solutions would come first, and in the end they did. So the IPS was not involved. Rather, it was sort of several rounds of political negotiation involving different options, including even privatization of NordLB. There were private investors waiting for buying it. But then also I think it was 2 states who have stakes in the bank, plus the regional savings banks. And so after long bargaining, the agreement was that the states would take most of the burdens, and some burden, I think, was taken by the local savings banks, but no private investors. And I think, I mean, maybe I've been defending the sector too much in this call to be a bit critical here. I think that is one example why you can question whether it's meaningful to have such an institutional setup, because first of all, private investors have a good track record on what they do with the banks they buy. You see that in Austria, you see it now in Germany. They are apparently more able to bring about turnaround and structural change than the incumbent owners. And then, I mean, we cut off the colleague from the ECB, but I mean, I got it what he was going to say. Of course, in a way, it is taxpayers' money that is going to the bank, and that caused long political discussions, including, I think, a regional finance minister stepping down, etc., etc. So that's not the best of all worlds, and I think the bank is also not doing particularly well now, but I'm not completely informed on this. So it's probably not the best outcome that we have seen for NordLB.
Yes.
Just a quick addition. So I think one important feature that we can take away from what Michael has just described so well, it is not that you first target the institutional protection schemes, then you discover on resolution weekend, oops, there's no money, and then you turn to the state. It's from the outset, you see the crisis coming, and when you see it coming, of course, you play through all the factual scenarios that you can imagine, and then you start bargaining. Of course, the situation, and you can go all through all these situations more or less, but North LB is, of course, a prime example of that, will always involve a situation where it's unclear which road you will pursue. So once again, it's not really the institutional setups that matter so much. It's really, I think, the political situation in which you enter if you have a sector that is publicly owned. I think that's something that is important to understand here.
Yeah.
If I'm mistaken, Michael, you're back?
I mean, clearly, if you look at the example of Nord LB and you observe the political tensions, and they were really tough within the regional governments, but also within the sector between the savings banks and the Landesbanken, and then the National Association and the Regional Association, etc. All this can only be read in the context that the participants in that game were not fully convinced that the IPS would hold, to say the least, right?
If I hear you correctly, neither the relevant regional funds nor the Landesbanken fund were defeated. So basically, they call taxpayers' money, despite some money still being in the system that is supposed to be intended exactly for that kind of situation. Is it a fair way of portraying it? I'm asking the question because not all of this is in the public space, at least in a way that can be understood by analysts like me. So I'm not sure I get it right.
Well, look, again, it's a philosophical. I think the defendants of the system would say, look, the IPS was not needed because the owners found a different solution, which technically is true. But I mean, looking at the broader context, I think it's rather a sign that they did not trust the IPS to hold, and so they better didn't want to rely on it.
Fascinating. Also on the experience of Nord LB, I understand from German media reports in the last 2 years, there has been actually a decision by the savings bank system to create a new fund that would be a national protection fund that would complement those 13 regional and specialized funds that exist. Can you tell us more about this and whether it will materially change the architecture? It's going to be according to media reports, put in place over a very extended period of time. But is it a game changer or is it just incremental difference? Michael first and then Tobias.
Yeah, I mean, to my knowledge, this is also in reaction to what the ECB has stipulated, because they also were not fully convinced of whether the IPS would be strong enough to justify all the regulatory consequences that come from it, and I think a lot of technical changes plus injection of new money into the pot have been the conditions from the ECB, and so this is now stretched over a period of time because it's really a lot of money. I would say yes, it makes the IPS more stable and more reliable, but I wouldn't say it's a game changer black and white, so it's more the degrees of gray. It's certainly getting stronger within the context of the system as such.
Yes.
So maybe just to add one aspect. So I think it's important to understand that these funds are not sitting all on a pile of cash. So it's not really that there's an upfront payment that gives them their firepower. It is much more based on drawing rights that they have in the crisis, and therefore, what can change the relative momentum that such funds have is, of course, how much essentially capital you reserve ex ante for these funds. And therefore, if you create a new fund, per se, that doesn't change anything because it's still, the pie doesn't grow through that. But of course, if you reserve more parts in the pie in good weather conditions for resolution, that can make a difference. And that is exactly what the ECB is demanding. And therefore, I think depending on the outcomes, but I'm not any more enlightened than you are, Nicolas, in this regard. Depending on the ultimate design of this new fund, it can make a difference, but not in kind, just in degree.
As an outside analyst, of course, I would be thrilled if there was more public explanation of what agreement appears to have been reached in that domain. But maybe that's asking for too much. And I have to mention that Mark Adams has asked this question on IPS funding. Reading his question, the IPSs provide very broad protection, but have quite limited ex-ante funds or access to liquidity. And as Tobias pointed out, governments have needed to intervene in larger cases. So I guess you both agree with that characterization, correct? Okay, so there are tons of questions and really good questions from the audience, and we won't have time to give them justice as usual, but we already covered a little bit of ground. I would like to go to the questions that were asked by Bastian Jasbeck, who works, I think, at the Single Resolution Fund. And he writes, the cornerstone of IPS is that it implicitly assumes that any cooperative, actually I think he means no cooperative banks, could become failing or likely to fail. For that reason, he means that. For that reason, one might believe that cooperative banks do not need MREL, minimum requirements for eligible liabilities. As IPS is not explicitly mentioned in the Bank Recovery and Resolution Directives that sets MREL requirements, does that make cooperative banks being non-resolvable? Do you agree? And he then followed up, or put it differently, how precisely do you think the resolution framework should consider the existence of IPSs? So this one is for you, Tobias, because it's covered at length in your paper. Are banks in IPSs, not just cooperatives, are they practically exempt from the resolution framework, or how should we think about that?
So many dimensions to this. So they're not technically exempt. I mean, if they have a banking license, they are, of course, come under the regulation. But here something is important. So we've talked about all these mutual support agreements and these funds that exist in order to resolve a crisis that occurs in an IPS. But still, the IPS as such is not treated as a consolidated entity for resolution purposes. So they don't have to prepare resolution plans on the consolidated level. So it's only the individual institutions, and only these individual institutions are also subject to MREL requirements. So Bastian makes a very good point. I mean, if the promise of the institution protection scheme is true, we'll never reach resolution, right? Because they will always be somehow miraculously rescued within the system. And therefore, even this institution-specific MREL requirement that we have in the regulatory framework goes beyond that. But that's obviously already not the belief of the European regulator. And in our paper, we make the case that the framework as such simply takes a different approach, and we cannot automatically exempt a whole sector from it. And if the scheme is so good as it claims it is, then the MREL issuance will not be much of a problem for the sector, simply because the risk premium that markets will charge for this instrument will be very low. Because they don't carry any risk. And our take in the paper clearly is to recommend, let's do the MREL calculation on the level of the IPS and then see what happens. So this standalone thing with regard to MREL is something that we do not favor.
By the way, there's also a question on the same topic from Felix Brinkmann and Pamela Lindner on the relationship between IPSs and BRD. Is it the case actually, Tobias, that BRD do not recognize IPS, as Felix Brinkmann asks?
So the question is, what do you mean by recognize? When you talk about recognition of IPS, that is a technical term of arts from the capital requirements regulation. And it says, if it is in recognized IPS by the competent authority, so by the national supervisor, then there are certain rules that apply. and certain privileges that apply. So it is not that they are generally exempt or anything like that. And there is no special treatment of IPSs in the BRRD, but the mere fact that we do not consider the members of an IPS as an entity for resolution purposes, etc., is already a regulatory privilege, if you will, or it is at least a regulatory stance that is taken towards the IPSs. And therefore, you cannot say they are exempt, but they are treated in a way that at least differs from what you would see in a consolidated bank group.
Michael?
Yeah, I only agree with that.
So we're getting closer to the end of the session, and there are so many things still to be asked. But I will focus on first one question also asked by Pamela Lindner. There's been a recent initiative in Poland of creating a national IPS of the main banks, which is kind of intriguing. Have you looked at that? Is there any lessons from there?
So unfortunately, my Polish is too bad. So I could not look into the details. I know of the initiative. There are a couple of initiatives. Italy has something relatively recent in this regard as well. And there are some upsides that you enjoy, particularly in the regulatory space, and why not try it? I mean, it's, but I have nothing to say about the Polish initiative specifically, I have to admit.
Michael, do you have views on the Polish case?
I'm sorry, my Polish is not better than that of Tobias, but no, I haven't.
Okay, so let's get to the cosmic questions for the 3 minutes we have left. And there are a number of cosmic questions in the Q&A, so I want to give them at least partial justice. Mark Castle, who wrote a book about German savings banks, asks whether there is, I'm reframing his questions a little bit, whether there is more moral hazard in the IPS or in a standard deposit insurance scheme. And a related question which he also asked is whether German banks would be asked to pay twice if the IPSs were integrated into a European deposit insurance architecture. And then we have questions, and I'm not going to read the questions at length, but by Pierre Raffi, David Wright, and Victor Sebeck, which are really about the banking union. So yeah. Whether it's even possible to think of banking union given all these differences, and also François-Joseph Schlichen, I think, Shishan. How, maybe François-Joseph is also mentioning the recent Franco-German difficulties. I mean, is there any possibilities of integrating into the same system the French system with a few mega banks, the German system with its very quirky and impenetrable IPSs in one architecture? So let me pack all this together and give you the floor, maybe first Michael and then Tobias to conclude before we get to the
thank you, and I'm glad you took these questions up, because I saw, for instance, David's question in the where they put the questions. I think this is a very, very important question. Where is Germany standing right now on banking union? And if you speak to anybody in Germany and explain the concept of banking union and capital markets union, and that's very easy to explain, nobody will object to it. So all the Germans should be supportive of banking union and capital markets union. Why is Germany not more active on that? And then I think is what the French speaker called au fond, what do they really think? What do they fear? And here I think the observation today is that German banks, and especially the banks that have been more from the private sector or come from the private sector, they are not sort of performing on level with their international or European peers. And international and European banks are making heavy inroads into the German market. Now that is okay. I think if we have a European market, we should live with the consequences, and it's to the good of the customer and the economy overall. But still, in the mind, say, of politician, that strikes a chord which is sort of not easy to digest. That maybe German banks are falling behind, and what will it mean if more inroads from international banks are possible. And also the electorate, the population, they are so conservative, they would like to have anything as they have had it all the time. Sorry about this. So I think these two playing together, the weak performance of the financial sector in Germany and the general mood in the political sphere and the conservative population, makes it so difficult to support an idea which in principle everybody shares.
Yes.
So I think that was already a pretty nice closing statement. Let me just add on this. So if you design a system where you have both deposit insurance of the private banks and the IPSs, of course, they should not pay twice. They should not be penalized for being on IPS. But the new feature that gets introduced is that if the IPS gets in trouble, it gets support from the deposit insurance system of private banks and vice versa. So yes, they would have to pay for private banks, which is something that they, is politically hard to sell. But of course, that's an efficient system of mutual support. And the other tiny aspect, is there more moral hazard in an IPS or not? In theory, there are reasons to say that is the case, but then of course you have all these controls in place. So, as an empirical question, I think it's hard to assess because that's, again, a question for the machine room in which I don't sit, unfortunately.
And indeed, there is a whole piece of the landscape that we didn't cover almost at all in the hour, which are all these monitoring mechanisms and the supervision of IPSs within the IPS system, not to mention public supervision, which is also an issue. But we're past the hour. Let me thank the two panelists, Michael Wolgast and Tobias Tröger, for very enlightening comments. I learned a lot. I hope it was the same for the audience. Our next session in the financial statement series will be on November 9 with Peter Pratt, where we will discuss systemic risk in the context of the Eurozone and especially Eurozone policy. Of course, that connects with his former experience as a monetary policymaker, both in Belgium and at the ECB. And in the meantime, again, I'm very grateful to our two speakers, to the engagement of the audience, and wish you a great rest of your day. Thank you very much.
Thanks a lot.
Thank you. Bye-bye.